Ladies and gentlemen, welcome. This is Bert Dohmen with the Chart Guru. Let's look at the S&P 500 chart today. That's this candlestick chart that has been going up very nicely here for several years. Here's the correction that we had from June to basically end of September. It was a nice double bottom here. We got some bullish divergences at this low, and then there was a sharp short covering rally. Now we're getting towards this very strong resistance area. All the stock up here is ready to be sold, and so there will be quite a bit of more supply coming into the market. This is what we have to look at. This is a weekly chart, so each one of these bars here is 1 week of trading. So it's a long-term chart. I have superimposed on that the chart of the junk bond ETF. It's the HYG, and you can see here that at a certain point, they were going up here together, but then in early 2014, there was a big divergence that started, and the junk bond ETF started going down, 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 while the stock market via the S&P 500 was still rising, although it was doing this here. This is a distribution pattern. Distribution patterns are when the big smart money starts selling into a rally, and usually the buyers are the more naive money managers. It's no longer the public. The public is not very heavily in the market, considering the low volume that they generate. So here we have a trend line that you can draw connecting these different lows. Here's an important low, and the trend lines that I find very useful sometimes are when you connect these bottoms, and then you can see that trend line penetrated, and then the market goes back up to this. This is often a fake out rally. And I say often because there's an exception to virtually everything. So right now the stock market is getting into a strong resistance area from this, as well as from this trend line from underneath. So it's time to start being careful. Also, what this divergence here between the junk bonds and the stock market shows is stress, credit market stress. And credit market stress is always the first big warning signal in any serious bear market. We saw it in 2007. They started diverging. It took another year for the crisis to really get into full year. So here we've had it now since mid-2014 at minimum. And so this divergence is getting rather long. The junk bond market, of course, has been declining because so much of it, $210 billion or more, is from the energy sector. Now, the bulls will say that it doesn't matter anymore. Everybody knows this, that the energy sector is in bad shape, so therefore it's not important. Well, in our view, it is very important, because when energy goes down, it means that the world economies are starting to contract, and that is something that the Federal Reserve's QE and interest rate policies, etc., cannot change. These forces are very, very big, and as we saw, all the QE money printing from the central banks have not been able to change the dismal economic performance. So let's see how this develops. We comment on this in our Wellington letter, which comes out 2 to 4 times a month. And this is something we look at very, very closely. So if you're interested in chart analysis, this is something that you should look at on a continuing basis. Thank you very much for being with us today, and come back for the next video, which we will try to do in a not too distant future. This is Bert Dohmen.